Bitcoin and gold exploded this week because investors suddenly got nervous about the US dollar. Bitcoin jumped about 23%, nearly touched $80,000, and had its best week in more than 3 years. Gold also surged. This was not random. America's debt crossed $40 trillion, the bond market flashed warning signs, and the US Treasury stepped in. The dollar weakened, and money rushed toward assets that cannot be created without a limit. Before you race to buy after the jump, understand what happened. This story is bigger than crypto. It is about how much America owes, how expensive that debt has become, and what investors think may happen to the dollar. By the end, you will understand the whole chain without needing a finance degree. Welcome to The Lazy Wealth Bro, where we make confusing money stories simple. Let's get into it. Start with the bond market. When the government needs money, it sells treasury bonds. Think of a bond as an IOU. Investors lend Washington money, and Washington promises to repay it with interest. US bonds are normally treated as very safe. But lately, investors have wanted a higher return before lending for 20 or 30 years. They see huge debt, large budget gaps, stubborn inflation, and more heavy borrowing ahead. That pushed the 30-year Treasury yield to around 5.34%, its highest level since 2007. Here, a rising yield means buyers are demanding more interest. That makes borrowing more expensive for the government and can also push up mortgage rates. Then came the surprise. The Treasury said it would at least double certain buybacks of older, long-term bonds, from $2 billion to at least $4 billion per operation. In normal language, some older bonds had become harder to trade. The Treasury offered to buy more of them back to help the market move smoothly and reduce pressure. But this does not erase the debt. It is not free money, or the same as the Federal Reserve printing dollars. The government is managing which bonds are in the market, while it keeps issuing new debt. Think of it like a store, buying back old gift cards, so they are easier to trade. The cards do not disappear, and the store still owes their value. The move simply makes the system easier to handle. Calling it money printing would be simple, but wrong. Still, markets react to what a move suggests, not only what it does today. Investors heard a louder message. Washington does not want long-term rates running out of control. If it tries to hold borrowing costs down, some believe the pressure may appear in a weaker dollar. That fear moved markets. The dollar fell, while Bitcoin and gold moved sharply higher. So why did two very different assets travel in the same direction? Gold has stored value for thousands of years. Governments cannot create it with a button. Bitcoin is newer and far more volatile, but it has a maximum supply of 21 million coins. When people fear growing debt or cash, losing buying power, both can look attractive for one basic reason: scarcity. They are not the same. Gold is usually slower and more stable. Bitcoin can move 10% before breakfast, and it does not rise every time the dollar falls. But this week, the connection was clear. The Treasury surprise hurt confidence in the dollar, and investors wanted alternatives. Then three more things poured gasoline on the move. First, big money returned. US spot Bitcoin funds took in about $1.6 billion from Monday through Thursday. More than 600 million arrived Thursday alone, the strongest day since May. New fund money creates real demand for Bitcoin. Second, Washington gave crypto another boost. President Trump urged lawmakers to move forward with new crypto rules. Markets like clarity because investors feel safer when the rules are easier to understand. Third, traders betting against Bitcoin got trapped. When Bitcoin rose, many bets were automatically closed. Closing them required buying Bitcoin back. That forced buying, lifted the price, trapped more traders, and created even more buying, like dominoes falling upward. Billions in bearish crypto bets were wiped out. If the headlines finally make sense, subscribe to the Lazy Wealth Bro. We explain what noisy money stories actually mean for normal people. So, should you run out and buy Bitcoin today? That is not the lesson. The dangerous time to make a money decision is after an asset shoots higher and fear of missing out takes control. Bitcoin may climb or give back this move. Nobody knows. A 23% jump proves it can move fast, not that it became safe. The bigger lesson is about confidence. $40 trillion of debt does not make groceries jump overnight. But growing debt, rising interest costs, and questions about how Washington will manage them can eventually reach ordinary people. Higher bond yields can mean costlier mortgages and car loans. A weaker dollar can raise the price of imports. And inflation can make your cash buy less, even when the number on your screen never changes. That is why this week matters. Bitcoin and gold exploded because confidence in the dollar weakened just as fresh money entered Bitcoin, and short sellers were forced to buy. The Treasury move opened the door. The weaker dollar gave the first push. ETF money and the short squeeze kicked the door wide open. Do not panic or chase a price because everyone is talking. Keep emergency money safe, understand what you own, and never put rent, food, or bill money into Bitcoin. It can be part of a plan. It should never replace one. If you want the next video to explain exactly how America's $40 trillion debt can affect your paycheck, comment debt below. Like the video, subscribe to the Lazy Wealth Bro, and remember, no noise, no hype, just the money stories that actually affect your life.